Okay, action today in real estate. Today is March 5th, Thursday, and there is a lot going on. Yesterday's podcast ended up chatting about how the price of oil and what's going on with Iran is going to impact interest rates. And we're going to see seesaws, volatility, and we're already seeing that today in the bond market. You're seeing the bond market retreat back a little bit today. I haven't taken a deep dive as to what the actual data is. And honestly, I don't really need to because I know it's going to do this song and dance for quite a while here. And just interest rates in general, this might be the new norm of how interest rates work on a broader brushstroke of the market because the bond market now can look at data points at a millisecond, right? We all have everything at our fingertips now from that standpoint. So I think moving forward, just I think rates are going to kind of move in a more wild fashion than they did before COVID. I think COVID changed a lot of economic industries, and I think the change that it made to the interest rate market, it's not an industry, obviously, the mortgage industry is an industry, but the interest rate market or the money market in general, just the flow of money is insane levels of peeling back layers and thoughts of what the future might do, which is what markets have always done, right? The stock market, the bond market's always thinking about the future, right? Thinking about what's happened in the past, what's happening today, what's happening in the future, right? Like that's the three levels that you kind of look at. You look at the past to kind of get an idea of what might happen in the future. You look at the data points of what's happening today to understand how a business is functioning or how money is flowing. And then you make a decision based on the risk of what might happen in the future, right? Based on those indicators. So that's always been the math. But now we're able to get information about history and today like that, right? So the information that people are getting in to make these decisions, I think is just happening so much faster than it ever did before. I think it's happening faster than even right before pre-COVID, because as COVID happened, right, that flow of information just got amplified, right? Like people just it just happened that way. So I think interest rates are kind of stuck in this weird mode of up, down, up, down, up, down in these levels that we didn't really see prior to COVID, right? Interest rates moving a quarter of a point in the span of 3 or 4 days, up or down, right? If you had a rate of 6.5 and then all of a sudden 6.75 or 6.25, and that happened within 1 week, that's not very normal from the standpoint of how quickly rates rise and fall, right? Usually it's plotting in typically either direction. And if it is knee jerk, it's knee jerk for one. Like the last time I could think about rates moving like this before COVID, and I know there was other times, but there was really only one time that rates went poof and jumped up, and it was actually the day that Trump got elected in 2016. Rates went from like the high threes to the low fours overnight, 1 day increment of everyone in the market thinks it's going to be Hillary, and everyone in the market thinks that if Hillary wins, it's Obama to Hillary, Democrat to Democrat. The market's going to be the same. The market didn't really flinch at that. No one thought Trump was going to win. And when Trump won, the wild card of him, no one knowing what he was going to do, the ripple that sent into the market, particularly the bond market, is it just caused a lot of indecision. Indecision means you go to cash, right? That's I talked about that a lot yesterday. Is when there's indecision in marketplaces, usually you go to cash, right? That's those days where it's I might not talk about it on the podcast. That could have been my newsletter to agents, but when there's indecision in the marketplace, what you see based on the indecision and indecision in a marketplace for like stocks, bonds, investing money, that the indecision is we don't know what the future is going to hold like at all. We're really concerned about the future, right? In general. This conflict in Iran is kind of causing that. So you're seeing stock market act funky, you're seeing the bond market act funky. Just a lot of indecision of like how long is it going to be? When's it over? What's going to happen? Is it World War III? Is it not? Right? Just a whole lot of different, paths that the world could go in. And we're getting that information every minute. Every minute information is changing, and every minute investors are changing the decisions they're putting their money in places, right? That's just amplified over the past 100 years. 100 years ago, when you invested in a business, you didn't even own that business until, you know, it got word that you owned some of that business. That probably took a while. I don't know the numbers, but I think if you were to buy stocks back in whenever the stock market started, I don't think you like instantly got gratification like you do in Robinhood, where you're like, transfer my money, buy this stock, you own this stock, right? Like, I know it's not really how that goes on the back end from the standpoint of the broker house of Robinhood and holding the actual paper. I know there's some complicated stuff there to make it look like they're representing that you own that stock, but you don't yet because it's really got to settle through the actual system. But same idea before, right? Like you kind of did, but it still took as long as it took the mail to get to wherever it was you were trying to get to your broker, right? You had to go to your broker's actual office, right? Or whatever it was. The means of information has just amplified and it's faster. So from that standpoint, it's going to do this seesaw. That last time I saw rates do that, 2016, it was just the day that Trump got elected, rates 3.875, rates jumped up to like 4.25, 4.375 instantly overnight. That was a very knee-jerk thing. We did not see the rate market do that again until 2022 and or around COVID when rates started plummeting. Actually, at the very beginning of COVID, before the US shutdowns, rates went up a little bit briefly and then kind of came back down because banks didn't know what was going to happen, right? So all over the place. I think that will continue to happen, right? Which kind of leads me into the next piece of the talking point today, and then we'll do a deep dive on a town is AI and how is it going to impact mortgage lending? How is it going to impact you as the consumer? What are my thoughts on AI in general? Because it's just popping up everywhere, right? It's the new hot button thing, so we might as well chat about it. So AI in lending I think will make mortgages faster, will make it easier to find out if you qualify, will flatten the information gap, right? From the standpoint of if I'm a loan officer and I'm giving you information about a Fannie Mae guideline, a VA guideline, a USDA guideline, that stuff is now at your fingertips with AI, right? It kind of already was before. You could find it, but you'd have to really know how to navigate Google to get to the right page, to then get to the right guideline. Now you can kind of intuitively ask AI. And I will say, AI sometimes gets it wrong, right? That is one piece of it too, that'll be a fun part about the fact that the information will be flat across the board from the standpoint of what loan officers used to bring to the table value to a client is being a guideline guru. I think that's still going to matter, right? You're still going to have to be educated, understand guidelines, read them thoroughly, make sure you're putting a client not only into a loan program that they qualify for and want to sign up for, but that, there's no red tape that's going to come down the pipeline of, oh, by the way, I think you qualify, but you really don't because I missed this guideline, right? Like that, you're still going to need to be sharp as a knife as a loan officer. That's not gonna change, right? What might change is how quickly you can get sharp and how fast you can educate yourself and stay up to date with guidelines with AI as a loan officer. But I will say that AI from a large language model, I'll give you an example. We're using AI internally within our guidelines so that I can search guidelines very easily based on a solution-minded question, right? So for example, VA client is trying to do an interest rate reduction loan. Just want to double check to make sure what are the criterias that you need to meet to get a VA EARL, which is the streamlined refinance. And, there's two criterias that are kind of snags sometimes is you need to lower your rate by at least a half a point from whatever your current rate is. And then you need to recoup the funds that were used for closing costs. So if there's points, whatever the prepaids are, escrows, whatever the total closing costs are, you have to recoup that money in a break even for the monthly savings in 36 months. Right. So that's one of those weird ones where like maybe you're meeting one of them, but you're not meeting the other and it doesn't work and you got to fine tune it. Right. It's just like a quirky little thing like, hey, let me double check it. Went into my guideline system, asked that question, and it's pulling the information from a small language model, which means it's looking at the information we've given the AI within our guidelines, so the VA guidelines directly, and then it's spitting me back out an answer. It's not going to the internet and getting me an answer because the internet is a grab bag of mixed information, right? So, because the AI doesn't know what's right or really wrong because it's not calling the VA afterwards going, hey, I'm about to send Mike Nielsen this information. Can you just confirm this for me before I ship this over to him? Just want to make sure I'm sending it right. No, it finds the information and it ships it, right? Like it's just got one dumb I know we call it artificial intelligence, but it's also artificially stupid, right? It just kind of does what we're telling it to do in that moment and brown noses a little bit, right? Like it wants to give us an answer. So that's where on the large language model, the information is going to be flat, but now we're going to also have to parse through, did you get good information, right? So a loan officer is still going to be relevant because until that gets fixed in AI, and if AI keeps hallucinating, and I think it's going to, if the version of AI I'm speaking about, which is the large language models that are probably going to do a much better job of replacing Google, we're just going to have to understand that it's the same problem that Google has, that just because I Google something doesn't mean it's right. So I find it on the internet doesn't mean it's right. Just because AI put it together in a nice, neat, formatted, really smart sounding 3-page essay doesn't mean it's right. It's just information. Take it with a grain of salt, take it for what it is, right? So that's what I think in terms of like from a consumer standpoint, where the big impact's going to be. And I know a lot of places are making big bets on AI chatbots. I'm not one of those people in that camp that thinks that AI as a human interface is going to be a good thing and or a profitable thing in the near future. I just really don't. That's my bearish take on AI. I think AI is definitely going to exist in pretty much every industry. Some industries is going to insanely make them more profitable and make it a better industry as a whole. I think AI in healthcare is going to be amazing. I think particularly in the small language model of like, you know, just healthcare information, not the internet. So like, hey, AI, digest this info. It's going to be awesome for stuff like that, right? Like, how do we put together this person's nutrition plan based on their blood work, based on their exercise routine, based on their food intake, right? Like, based on how old they are and their genetics. And that's just like computing that humans, only a couple humans in the world can probably actually even look at that type of data pieces and go, yeah, let me try to get you some sort of an answer here, right? Like, how do we do that math? AI is going to create new ways that we solve problems that we didn't even know we had, right? 100%. In lending, I think where it makes its real big impact is helping loans go quicker, helping quality control on the back end of closing and funding loans, preventing fraud, right? All across the board. Now, at this point, think about it from the standpoint of saying, hey, I want to audit every single email any loan officer's ever sent. You can do that in a heartbeat now, right? So I want to audit every interaction you've ever had with an appraiser. I want to audit any interaction you've ever had with a consumer, right? That stuff is going to be now fingertips right there. It does it. Here it is. Here's all of the emails Mike Nielsen's read and or sent in the past 3 years. Did he do anything that's fraudulent? Right. So like it's going to help in that regard to make sure that the market stays true because it'll just mean that you can look at things quicker. So speed. It's going to help with speed and efficiency, which is not necessarily replacing talking to a human and gaining confidence and trust. And I think this is where a lot of the market misses the boat with mortgages and buying houses, right? And I know we're all guilty of it to a degree or another. And I am too sometimes because I focus on it because I know that my clients deserve me getting back to them quickly with fast answers. That doesn't mean that you should be making big decisions in a hasty manner, right? So I think that's the part where it will have a hard time replacing a human because if it's a chat bot that isn't a human, doesn't know what human problems really are, hasn't walked a single step in a human's foot and has lost a loved one, has had to move for sad reasons, has seen a parent's house get sold and you didn't want that house to get sold because but it had to, right? You saw your aunt's house get foreclosed on. You've heard troubles about people's home that they bought, that they had a home inspection, but the home inspector missed something, and it hasn't walked one single step in a human's shoe it can't talk to a human the way that another human can, and it never will be able to, right? And I know I'm being hyperbolic with my tonality here of how I'm approaching this. Like I'm talking to all the people out there that are trying to implement chatbots, and I know my company is doing it too. We're doing it in the sense of reaching out to people and connecting with them. And I think there's going to be a place there for that too. I think there's going to be like if it's doing a really stupid job, right? If it's a, hey, let me call you and schedule you a time with Mike, right? I'm not going to answer any of the other questions, but I'm going to schedule a time with Mike. I'm an AI chatbot and I can schedule calls, right? I'm hooked into his calendar. I can schedule you calls. I can set you up with Mike. Mike's available 1 o'clock on Tuesday. You want to talk to him about your problem? Great. Here you go. You guys go have a human conversation. It's going to get really good at trying to talk like a human. I still don't think it ever gets there. I know there's a lot of people that are completely the opposite of me that are like, Mike, this AI stuff is well beyond what you ever thought it was. It's so smart. It's this, that, and the other. All that fun stuff. I still say nay. I still say it's not a human and never will be a human. And the moment that it is a human, we're going to have some problems, right? So the moment that it is better at understanding how to connect with another human more than I am, we're going to start having some problems, right? Like I think that's where it starts to get bad because I think most people can smell the AI in your email if you're using AI to make your email, right? I think most people know if someone calls your phone, jumps on and says, "Hey, Mike, how you doing? I'm here to call you about that offer that we had." You know it's AI. You can feel it. It's AI. You know it's AI by the tone of the voice and the you just know, right? You smell it, you sense it, you feel it, all those things, though, that gut that we have as people, as flesh bodies on this earth with more going on than what we understand, right? Whatever energy is and spirits and souls and all that fun stuff, right? So more than what we can understand, that intellect, that intuition, that gut that we have as things, right? It doesn't have that. And I don't think it ever will have that. I don't think it's going to know the right moments to pause and let someone talk. I don't think it's going to know those moments. So my guess is AI as and this is a self-serving biased guess. Guess as AI as a loan officer, that's someone you call and ask advice from about making a big financial decision, right? Because that's my above and beyond job of just making sure you qualify for a mortgage and close your loan, right? Regulation would say that's all I should focus on. Shouldn't focus on, talking to people on a people level to a degree or another. That's what the government wants. That's what they want us to be regulated down to, that everyone gets treated like a number and not like a human. And we don't talk to you as a human on a human level. I'm here to tell you that no one does that way, right? That's what the big companies do. That's what the turn and burn companies do. And you know it when you call them. You feel it when you call them, right? They really don't care to a degree or another about you. It's just you're another number. What could I say to you today to say yes to refinancing, to buying, to closing? What rate do you need? But there's no conversation about why you're moving, right? What does this house mean to you? How long do you plan on owning it? How like there isn't that extra thing. And I don't think AI will ever have the extra thing. I think it will always be a cold computer talking to you. I think it'll get better at starting to understand that, like how a baby gets better at starting to put words together. But then a baby eventually becomes a full-blown adult with intellect and a gut and intuition and all of that, right? So I think it'll get to a good stage of right now, if it's in its toddler, young kid stage, right? I think maybe it gets to pre-adult, talking to a 17-year-old about big, giant financial decisions. I mean, every once in a while, you get a 17-year-old that's like, boom, on the mark. I know if you asked me when I was 17 about a lot of financial stuff, I'd probably have some decently smart answers, but I'd also be insanely unreliable with my experience up to that point as to whether or not the information you wanted to get from me it actually could serve you in a better way, right? hadn't walked long enough in, the footsteps of being an adult and making these decisions and making the mistakes and doing all the things that come along with being a messy human to really give you any insight as to making big financial decisions at 17. I could probably regurgitate to you what people said in books, read a book, be like, hey, so the smart person that's done it before me says to do this, so let's do this. But that's just me regurgitating information. That's not me, hey, I've been there, done that, tried that. I have experience. I can connect with you now on a completely different level, right? That's a human thing. That is not a computer thing. It's going to start having some of that, but I do think it hits a ceiling at some point, at least on the connecting with humans piece. In terms of like the back end stuff of how quickly, like I could just take someone's loan profile and put it in a computer system, and the computer system tells me as the loan officer exactly what I need for documents when I need them by, how I can close it in a week. It's going to get insanely good at that stuff, right? It's going to blow me out of the water as a like I'm a one finger typer kind of guy, right? Like I'm gonna get completely trampled in terms of like eventually taking a mortgage application, putting in a computer, and having it do the nitty gritty stuff way better than me. Helping underwriters underwrite a loan, it's gonna make underwriters' jobs way easier to a degree or another and so much more simpler. And it's going to help them go from doing one loan per whatever metric you want to pick to three loans to five loans to 10 loans, right? Like it is going to definitely lift up a majority of markets, like broad brushstroke. It's going to lift up most markets that if people are using AI in a good manner on the back end, task oriented, because that's the stuff that like it's better than humans at, because that's the stuff that a lot of us humans don't like to do, right? We do it because we need to do it. But if a computer can replace us, we we're pretty reluctant to not let it replace us unless it maybe impacts us financially, right? Like, but otherwise, if it for me, clients going to buy a house, get a house under agreement, they then back out due to home inspection, right? Happens a lot. I'm going to make a whole new file for them. I'm going to move over their stuff, new pre-approval, new quotes, new closing costs. A lot of just minutia, right? And then eventually what you try to do as a loan officer, you try to hire an assistant that can help you with that stuff, right? That's like the next leg is like the little minutia of like, hey, I my best tool is me connecting with humans as a salesperson and helping them make hard decisions, right? Like that's my highest and best use as a person in the industry, trying to navigate the market and help people make good financial choices when buying their house. The highest and best use is when I am talking to people in that realm. And that's when I'll usually let time slide a little bit. That if I'm helping someone make that decision, okay, how many different ways can we chat about this, work it out, storyboard it, throw spaghetti against the wall, whatever analogy you want to use to help figure out the path forward of you have a problem that you're trying to solve. You're thinking about moving, you're thinking about refinancing, you're thinking about doing this. Let me walk with you along that path of solving that problem. And let me add my area of expertise in the space of being a mortgage lender. And how can I help you solve that problem? Right. That's my highest and best use. Copying a loan file, moving over documents, requoting the interest rate, uploading all of the closing costs, doing all of that, waiting for the computer to catch up because it's got to load, it's got to do this. That is something I need to do, not my highest and best use of my time. So if someone came to me and said, hey, Mike, AI just did that for you, you know what? It does kind of displace a little bit of the labor market, but not really, because I'm still going to eventually want to hire some form of an assistant. Just that assistant's not going to be doing that task. They will be doing a higher best use task of their time as well, right? If that makes sense. So they'll, hey, 5 years ago, you used to, if you were going to be my assistant 5 years ago, your job would have been copying files, doing this, doing that. You don't need to copy files anymore. So now your job is X, right? It lifts. I don't know what that job's going to look like in 5 years, 2 years, 1 year of what AI will do to lift people up and away from some of the not lesser tasks, just not as fun tasks or the highest best use of our maximum capability of trying to help other people achieve their problems, right? Because if you really think about or solve their problems, if you really think about our economy, we're out there in the marketplace all together working, but what we're really doing is we're all solving each other's problems, right? You just picked whatever problem you want to solve. If you're a doctor, you're solving the medical problems. If you work on cars, you're solving the car problems, right? But what you're really solving is further than that. Because if you're working on cars and solving their car problem, yeah, you directly just changed their tires, right? But the problem you actually solved is you kept them in a mode of transportation so they can keep staying on the road solving other people's problems. It's a giant loop of problem solving. That's how the economy flows with money. Because if we didn't have problems, we wouldn't need an economy, right? If you just went, give me an apple, and it just fell, we wouldn't need farmers, right? Take a turkey and it just fell, landed in my hand. You can't see my hand because it keeps getting greened out. If we didn't have problems, we wouldn't have an economy. That'd be a utopia, right? That would be a false narrative because it's not reality. But that's what it would look like if we didn't have problems. So AI is going to solve a lot of problems for us that we're currently trying to solve, but it won't replace the fact that there'll still be new problems to solve. They'll just be different and they'll require a little bit higher and best use of your ability, intellect, all of that, right? So it's going to lift up a lot of people. Some people, if they stay in the wrong mental position, it's going to put you down. Because again, maybe I'm wrong. Maybe it gets really good at chatting. Maybe it gets really good at understanding tone, really good at gut intuition, really good at all of those things. And in 5 years, I could be completely wrong. And it does do a better job of talking to a human about a human problem and solve that problem for them. Right. But I'm very bullish that I think that piece of the world forever will always exist of the human connection. No matter how smart computers get, because there's a tipping point there, right? Because they get too smart. Now I'm talking to humans about what's our problem. Our problem is that computers have gotten too smart. How do we fix this, right? There'll still be human problems, but unfortunately, if they get too smart, it'll be like the Terminator version of human problems. It'll be like, hey, we need to all band together to figure out how we take on these damn computers. So it'll still be the human connection between humans. Just computers will live in a different era of that time, right? So like it'll never go away. It'll never replace that. Okay, so that's me on AI. I think AI is going to make lending much faster. I think it's going to help you make quicker decisions, but I still think humans will be there to help solidify the fact of the decision that you're making. And I think the slippery slope is the replacing of the human at the problem solving level of the loan officer, of talking to a client on a human level of, hey, I'm moving. I know what I qualify for, but what should I do with my money? What type of house should I buy? This is what I'm like. It's going to get kind of good at answering those questions, but it's still going to be cold, right? It's not going to apply it. It's not going to have a story of like, hey, what me and my wife did and what I had a cousin do. And I just helped a past client and do that, right? Like it's not going to be able to do that. So that's the break for me is I hope that people with AI actually see it as a good chance to slow down. That as it creates a vacuum of time and space with getting more efficient in doing a lot of the tasks that we don't like to do as people, that we actually allow for the time to have the person connection because now that's what creates for a vacuum that if it gets that good, doesn't need to replace us, but can it make us a lot better? So that's me on AI and what I think is going to happen in lending. Now let's look at Hanover, Massachusetts, a couple towns over from the town we did yesterday, Marshfield. Pretty similar song and dance, slightly different numbers, pretty similar song and dance, right? So I'm going to share my screen. I didn't share that yesterday. Do it today so you can actually see the data I'm looking at. So let's take a peek here. So we got for sale inventory. We got it on a month by month basis. Let's go back to the high watermark before COVID. High watermark before COVID, 2016, 63 houses for sale. Low watermark before COVID, 33. Again, Let's take a peek. September of 2020, 2016. December of 2017, right? You're going to see that theme heavily play out in most of Massachusetts because we are a four-season state, right? We are a state that has all four seasons, sometimes heavy winters, sometimes hot summers, and every once in a while, springs and falls that feel like I don't even know what. So you're going to see inventory move along the season. And you're going to see September usually have the highest inventory because that's where you get a lag of summer. And that's where you get a pickup of inventory. People always think the level of inventory is the highest in the springtime, but what it really is inventory builds throughout the spring. But in terms of like if you just look at it stagnant of like what's available for sale right now in the market, the peak is usually some point in the summer because you get a lot of volume and a lot of houses selling throughout the spring market, right? Let's do April up through May and June and July, right? And then, it does flatten off in the summer and then usually comes back down. But that's just the velocity of, the absorption rate of houses coming on the market, houses coming off the market, and then buyer activity subduing. Buyers give up in the summer and the winter, right? Buyers that try to buy or they bought something in the peak of spring or in the peak of fall and they're no longer a buyer in the market, right? So that's the absorption rate is how many buyers are there compared to houses for sale, right? So what you see is you see the velocity of inventory ramps up during the spring, but the peak of available inventory is usually somewhere in the summertime into fall, somewhere in that ballpark, right? Usually. And then it falls back off because people, as we get closer to winter, don't start listing their house if they need to. You don't really need to list your house in December. If you don't need to list your house in December, you don't list your house in December in Massachusetts, right? Like that's what 9 out of 10 realtors would probably say that are like, hey, if you think you could take on a little risk that it's going to be a good spring market and we don't need to list your house right now in December, let's wait it out. If you don't need to, if you're a little nervous that you think the spring market might be bad, because who knows, then let's list your house now, right? Or if you need to list in December because you have to move to Texas for your new job, let's list your house now, right? So if you don't need to, you wait until spring market amps up, buyers exit the market because they get something or they give up. Inventory stays behind, more inventory comes on. You get that flattening there at the peak, and then it starts coming down in fall, right? End of summer into fall, into the dead of winter again, right? That's the low again, magically in the winter. And then there we go. There's the peak, June 2019, right? And then back down again. And the low point of 2020, 23 houses for sale, right? Back over. And then very similar, where the lows hit 2022, January, February, right? That was the peak of interest rates going from 3% to 5% and the knee jerk of the market going, oh no, what's going to happen, right? Low point, three houses for sale, February 2022. Starts amping up. You get a somewhat spring market, not even close to the low numbers pre-COVID. Again, same thing. And pretty same, level of floors and ceilings. We did this yesterday with Marshfield, right? Of like, okay, the peak 19 houses. Next year, February 2023, five houses, two houses better than February 2022. That's good, right? And then, not as good here. That's not a good number there, but who knows what actually happened in Hanover that month? All we can do is look at the numbers and make guesses. And then same idea, right? It's not as perfect of a trajectory as Marshfield was yesterday about, the new lows and the new highs being higher of a rebound of the market. I wonder what's going on in Hanover from that standpoint as to like, hey, why are we not seeing somewhat of a rebound market volume wise? We're kind of seeing the lows and the highs stay around the lows and the highs, right? So I'm wondering what's deeper there in that data point. So, houses for sale, January 2026, 9, right? So I wonder what's happening there because you're not getting that rebound like we saw in Marshfield. And that's kind of leading towards that home price forecast here, right? When there's a issue of volume, usually we get some form of price stability and or price increase from that standpoint. So let's go over home value, right? Now, this is pretty much the exact same as Marshfield. So if you watched along yesterday, I didn't show the data points, but now I'm showing it today. Peak in '06, 460, low point 2012, 370, you lost about 100 grand. It's pretty much the exact same as Marshfield. And then if you kept your house from 460 in 2006 all the way till now, the peak is around 780. Pretty much the exact same. And you got a little flattening in that 2022 mark. Again, looking back at the data point of for sale inventory, you can almost kind of take these data points, put them over each other of the peaks of inventory, low parts of inventory. That 2022 was a little bit of a dip down and a flat, a little bit flat, right? But mostly pretty steady incline 2020, 2019 into 2022. You got that massive jump that just from 2019, 515 to 2022. So 3 years, you had home values go up from 515 to 650, right? That's a big jump. That's a big jump. Because if you got 2002, climb, 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 crash, right? And that's a big crash. Oh, 08 is one of the worst real estate markets we have ever seen from a standpoint of value depreciation. But look at it. And this is what it looks like throughout all of most of real estate in America history, right? Up, 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 some form of a crash. The crash is bad relative to recent times of whatever the quote unquote peak is, but relevant to times before that. If you bought a house in 2000, sold it in 2012 in Hanover, you missed the peak, but you didn't lose money. 250 to 375, somewhere in that ballpark. If you bought a house in 2000, did nothing to it, and you paid 250 for it, and you did nothing to it here, it was worth 370 to a degree or another. Again, doing stupid math, but that's all I have in front of me is stupid math. I don't have how many bedrooms did you add, what neighborhood is it in. I don't have the nuance. I just have top of the funnel stupid math. So from that standpoint, real estate's always going to kind of do that. The ups and downs are going to be ebbs and valleys, but Hanover follows just along it, right? So what my guess is, and they're pretty close with them, is we're not even close to rebounded to even 50% of the peaks of the pre-COVID level, right? We're not even at 100% of the valleys of the pre-COVID level for what the peaks are now in this market. And if people still like living in Hanover and new people still want to move there, right? Someone's like, hey, I live in Boston and I kind of want to live in the suburb. Let's look at Hanover. And there's still an influx of people moving there and wanting to stay there. And there isn't a massive amount of new inventory that pops up out of nowhere. Some builders, building 300 houses as we speak. I don't think that's happening either. You're probably going to see prices remain relatively stable in Hanover from that standpoint. And that's kind of what they're saying here of their home price forecast. And this is the Venture app. This is some good information, and this is the free version. You can get a whole lot more if you pay some money. I really don't care too much about that. I like just looking at home value and for sale inventory. Because for me, when I look at for sale inventory and home value, and I think about interest rates and I think about human problems, particularly the for sale inventory and what the data is showing me and how I can help my clients make good decisions, right? Is prices for the most part are going to be pretty stable in the South Shore of Massachusetts, is my guess, over the next short run, bearing some sort of variable catastrophe that I'm not seeing in the tea leaves, right? Like, and I don't think you should ever try to gamble on variables, right? If that makes sense. You don't usually gamble like, hey, I'm going to buy real estate because I know that real estate's going to crash next year. I think people that think that way don't actually ever make a lot of money in real estate. And if they do, they make a lot of money in real estate, on accident. They didn't do it on purpose, because everyone that makes money in real estate on purpose is very intentional in their buying efforts, and they don't focus on the macroeconomics of what the market's doing. They strategically buy properties within their own credit window of risk tolerance, and then they just keep buying properties, right? Like, that's most people that I've talked to that make good money in real estate. If you're thinking about it from an investor standpoint, from a put my money here, do this, do that, right? And I think that's a little bit in the weeds for if you're a person that's buying a house to live in. It matters that your house grows in value, but there's only four ways to live in America. It's renting, owning, living with someone else, like a family member or buddy for free. You live on their couch, or being homeless. That's the four ways you can live in America, right? Rent, own, live with someone else, homeless. So if you're trying to parcel together, is owning a home a good financial option, right? You can't look at it from the lens of investing in other vehicles of a return because it's not the same thing. So you can't look at real estate and compare it to the stock market. You can't look at real estate and compare it to the bond market. You can't look at real estate and compare it to being a venture capitalist and investing in a business, right? You can't look at real estate and compare it to any of those things if it's a house that you're going to live in. If it's a house you're going to live in, you're going to buy it and live in it, whether it's a condo, single family, multifamily, whatever. If you're buying it to live in it for any period of time, you've got to view it through the lens of I have four ways to live in America. I can rent, I can own, I can live with family or friends, or I can be homeless. I have no family that wants me to live with them, and my friends don't want me to live with them either. I got, I don't want to be homeless, right? God bless anyone out there that's going through any struggles that happens to listen to this podcast. And, I hope you get on better feet at some point. I don't want anyone in that position, right? If it was avoidable, I wish we could avoid it. But it's a reality that unfortunately there are people that are in that boat. It's an option. Some people do it on purpose. Have at it. Or you can rent. So you can own or rent because the other two are harder to come by, right? It's harder to come by the family member that's willing to let you live with them forever. It's harder to come by having a good life and being homeless at the same time, right? So if you're trying to have a good life and you need a house, you can either rent or own, right? So don't make a bad financial decision by buying a house you can't afford because that's the same math on renting. Don't rent a house you can't afford either. So if you decide that you never want to be a homeowner, it's also would be a bad choice to rent a house you can't afford that puts you can be house poor both ways. You can be house poor with a rental and with a house you buy, right? But being the benefit of being house poor with a rental is you can move in a year. Being house poor with the house you own, you might have to short sale it. You might it's just you don't do either, right? If that makes sense. Both of them require the same math equation of can I afford this? What do I make per month? What does my cash flow look like? What's my budget? How much money do I have available for first, last, and security? How much money do I have available for down payment and closing costs? What kind of payment can I take on? What is in my responsibility threshold and what is not? When you're a tenant with the landlord, you have less responsibility and more flexibility. When you're an owner, you have more responsibility and you have less risk of being kicked out of your house. That's the real, like, if without looking at the math of money of like my rent's 3 grand and my mortgage is 4 grand and it appreciates, and without getting too crazy technical detailed about the subtle nuances on a macro financial picture of like is renting or owning actually better, if you just view it from the standpoint of your day-to-day life impact, because let's say it's flat. Let's say financially on the money out of pocket and the money monthly, it's flat, right? So let's remove that. So financially it's flat. What's the big difference there at the next stage? The next stage is you're probably going to sign a 1 year lease, maybe two, maybe three. Doubt if it goes any further than three, right? Maybe two, if you're lucky for stability, if you're worried about price and being kicked out and you want to live there for a while. But most likely it's a 1 year to 1 year lease at a time, right? And then from there, you don't have responsibility typically over, hey, the plumbing shot, you got to come fix this. Hey, the roof's leaking, you got to come fix this. It's on the landlord, right? So you have flexibility on when you can leave and you have less responsibility, right? But the risk on renting is after a year, your landlord can say, hey, remember when you called me all those times to fix the plumbing? Cost of plumbers went up. Your rent's going up, right? Which is something you deal with as an owner too. You deal with that as an owner. Right? If plumbers go up as an owner, plumbers go up for everyone, right? So it's just a different risk threshold and or potential positive outcome. When you're a renter, you have no positive outcome of the money you spent to rent. You just have dwelling. When you own, you have all of the risk of responsibility of taking care of that property for the most part, unless you buy a condo. But let's say you're buying a single family. You have all of the responsibility and risk of taking care of the property, which you should budget for. And then you at least get the benefit of if you fix the property up You get whatever it's worth at the end of the day if you need to sell it. And every time you make a mortgage payment, you gain a little bit of equity. And every time the property goes up in value, you gain a little bit of appreciation, right? And then you also, for me, this is really where I think the American dream used to live and still does live with a lot of people that I talk to. When you own, it's your house. When you rent, it's someone else's house. And I know for me, it feels a lot different when I get in my car compared to when I get into a rental car. I feel a lot different when I go home to my house that I own compared to when I stay in a hotel. One feels like home, one feels like someone else's home, right? Like that is something you cannot quantify. And when you go to become a homeowner, again, financially flat, mortgage payment 3 grand, rent 3 grand, right? Low down payment, whatever. And I know that's not the case in a lot of the market right now. We have some imbalances with rent compared to what single family prices are. And that's just going to exist, right? That you're going to have nuance. And in some markets, the opposite. Some markets, the single family homes gotten really affordable relative to other markets. Just that's going to be different everywhere, right? Like I'm not going to try to solve that right now. And I know that's a very complex thing to solve. But either way, from that standpoint, if it's flat math, you can't quantify with money what the difference between owning something is and renting something is. Because if you rent and the landlord wants to kick you out in a year and your lease is up, you just got kicked out. That landlord says, "Hey, I'm retiring. I'm moving to Florida. I'm selling my house. I know you've been renting with me for the past 5 years, but I'm retiring. I'm done. I'm out." Now your dwelling is at the control of another human. If you own your house and you make your payments, no one's taking that house from you. So if you work hard, make your money, everything's going good, you're having a good life, you're making your payments, everything's going good. Again, this isn't me to say that not everyone, sometimes people go through bad times and situations change, right? But let's say everything's going good, you make your payments on time. There's not a point in time your bank calls you and says, "Hey, I'm taking your house," right? That doesn't happen. That's not, I know maybe you could find some sort of silly Reddit threads that say otherwise. But legally speaking, if you are taking care of your home and you are making the payments and you have insurance on it and you have a mortgage and you did all the things on your promissory note that you said you were going to do, payments on time, paying the taxes, upkeeping the house, as well as keeping insurance, right? That lender's never going to call you and tell you we're taking your home. You got to leave, you got to vacate, you got a year, get out, right? That's just not going to happen. So the flexibility granted in renting is also its crutch. And then it's just the same thing on owning. The permanence of owning is also its crutch, which is why renting and owning, there's not a right or wrong, right? There's just risk on either side. And then there's determining whether renting or owning is right for you based on your life and your risk, if that makes sense. So that's today's action in real estate. I hope this helps if you were looking at, Hanover at the marketplace. My guess, again, values will remain relatively stable. I bet we'll see prices continue to hopefully level off and not climb at like crazy clips. I don't want to keep seeing that, but there's no inventory. So with the no inventory, if people keep wanting to live in these towns, right, not move from them, and for whatever reasons why people like to move to certain towns for schools, all the reasons why we buy real estate, I think prices in Hanover will remain stable, and they will not remain stable if something happens that I don't plan for, right? And I don't think you should ever plan for the unplanned, because the unplanned, you don't know what's coming. So that's today's action.